selling short stock or selling stock short, you've also, I guess that's all you guys have learned at this point. Up until now in this program. Okay, so you've got 4 core strategies plus the covered call strategy. Now, how do we determine when to apply these? Well, we're going to use all the analysis tools that you learned in level 2 that we've been building up with. We spent our time in the trader conditioning system. Hopefully you guys have been doing your trader conditioning and you're getting better and better at reading the markets. Here's your 5 steps to confirmation that we've talked about: support and resistance, moving averages, chart patterns, candlesticks, and indicators. Okay, so these are the 5 steps. Now what I want to do is we're going to go over to Trade Navigator and we're going to actually just do some basic trade setups. And I really want you guys to do these in your virtual accounts. I don't want you to do them in real accounts until you've proven it to yourself that you can make money. But I would love to see you guys start placing these trade setups in your virtual accounts. Okay, so let's start with the Dow Jones. And I'm just going to start right here with an index fund. Actually, let's do the NASDAQ instead because I'd rather trade Qs than diamonds. So as you look at the NASDAQ, and let's just kind of pretend we're in a mini short power trader here. If we're in the NASDAQ and we're looking here at where the NASDAQ has gone, well, we've traded up to 3,200 and we're running into resistance. So I got a question for you. Would this be the opportunity where we would want to buy and go into bullish trades, or we want to go into bearish trades? What do you guys think? Want to go into bullish trades or bearish trades? Oh, you don't know. You want to do some analysis? Thank you. I'm so glad you said you don't know. Okay, wonderful. Well, so initial thoughts. I can tell you my initial thoughts. My initial thoughts would be, are we in a trend? That's the first question you have to ask. Well, are we in a bullish trend or a bearish trend? Well, I would say, based on this picture, we've run into a bullish trend, but we're running into resistance. Well, knowing we're running into resistance in a bullish trend, what should we do? Well, we should check and see if we've got any better clarification. Okay, so do our candlesticks tell us anything? Let's zoom in on the details here. Do the candlesticks tell us anything in terms of which direction this trade's going? Well, they tell us that every time we hit resistance, we turn down. We've kind of got a little bit of a, almost an inverted pennant here. Until Friday, it actually was just really looking like a flag pattern, but now it's looking a little bit more like it's spreading out a little bit here. Volume was pretty good on Friday. Granted, that was an expiration day here. All the other volumes kind of been trailing off just a little bit here, but not crazy. So I don't know that we have any clear picture here whether or not this is a flag pattern shaping up, some form of a flag pattern, or whether this is some sort of a reversal pattern. We don't know at this point, okay? Let's go through some candlesticks. Don't specifically tell us anything. We have a small gap here. Okay, this could be a substantial breakaway gap, but it's a little too early to tell. We don't want to trade against the trend. We've obviously been a bullish trade, so let's check the moving averages. Well, looking over at the moving averages, what do we have here? Well, we've got a nice moving average cross. The moving averages are separating. They're all looking bullish here, so this looks pretty bullish. Oh, by the way, if I zoom in on the detail, watch this right here. If I zoom in on the detail, I'm sitting right on my 10-period moving average. Does this seem to be a place that over the last several weeks, the 10-period moving average has been a good turning point for getting into and continuing the trend? Yes or no? What do you guys think? So that would, yeah, the answer is yeah. So that would make a pretty decent argument for a bullish trade. Trends are assumed to be in effect until we've given definite signals of a reversal. We've obviously been in a trend. We are traded over into the moving averages. Moving averages are at a nice angle. They support the bullish trend. We got nice separation. Volume's not specifically telling us that we're going down, so don't have any necessarily great story there. No clarification. Let's look at the long-term moving averages on the NASDAQ here. Long-term moving average says, oh, well, we're above them. And the 200 period does have a nice, long, sustainable trend. Not a super sharp angle. Not sharp angles can sustain for a while. Now, the kind of turquoise line here, it's also taking off essentially at the same angle. So we do have support from the long-term moving averages for the bullish trade. All right, let's check the oscillators. Oh, interesting here. So as we look at the oscillators, RSI is heading down, suggesting bullishness or bearishness, ladies and gentlemen. That's suggesting some bearishness, yeah. Okay, the stochastics is starting to cross over. This suggests a little bit of bearishness, but Have you guys ever seen a situation when we get into a trend when you get overbought like this and the oscillators just stay up there? The answer is yeah. I mean, just come back over here. Just a month ago, right? We're overbought. We stayed there. We crossed down just a little bit, but we didn't really get into a bearish trade. We just rested for a little bit. You see that? Very typical in a trend that we will become overbought and we'll stay up in that zone. And even though the oscillators may cross down, it's not necessarily a bearish trade. And this is a really, really important lesson right here. If you're in a bullish trend, take bullish trades. Just because the stochastics cross bearish doesn't mean that there's a bearish trade to make money. Look at what happened in this bullish trend. We had sideways movement in the oscillator or in the stock index, even though the oscillator went down. Okay, so when you have sideways movement, your oscillator will cycle back down and correct a little bit here, even though the trend didn't reverse. That's why I always say trade with the trend. The trend is your friend. You don't want to fight the momentum of the trend itself. Okay, so right here, would we want to get into a bearish trade? Looking at this, knowing we're clearly in a bullish trend, the moving averages support it, the long-term moving averages support it, our trend lines support it. Even though we're at resistance, we don't want to get into a bearish trend per se, do we? No, that would be a little bit too risky at this point. Okay, and then looking down here at your MACD, we're starting to cross over into bearish, but we've not crossed over yet. Now, somebody mentioned here some bearish divergence, and I would not suggest that we have bearish divergence. We don't have any bearish divergence in MACD, and that's usually the king of divergence. We really don't have any in RSI, and the amount of divergence we have in stochastics is minuscule. It's very, very small. That's not the kind of divergence you get super concerned about. I'll show you one we do get concerned about in a moment, but this is not one I would be massively concerned about. Let's look at our Bollinger Bands and see if they help us clarify this story at all. Well, this is interesting. So the Bollinger Bands have been trading along. We hit the band, we trade over, hit the band, pull out. Guys, does this look like any kind of a pattern that we talked about when we learned about Bollinger Bands? What does this look like? This looks like a Bollinger Band trend trade. Okay, Bollinger trend trade, right. So we're basically trading right between these bands. No reason to be bearish if you're in a Bollinger trend trade, right? Now, we are starting to pull away from the band. The bands continue higher, and the stock is going sideways. That's not in and of itself a problem yet. It's just a problem for staying bullish. It's not a problem to say that it can't continue bullish. It's just saying we're slowing down, and it makes sense because we're at resistance. So this is a good place where things would start to slow down. Let's take a look over here at ADX. ADX is turned down, saying that this trend no longer has the sustenance that it did have. Okay, so we were actually above the 50 reading here, and we turned down on ADX. That actually is a bearish signal. Okay, it's not saying go bearish, it's just saying that this trend is done. Parabolics are tightening up further and further. So based on our analysis, what do you guys think could happen with the NASDAQ? Bullish or bearish? Either bullish or neutral. Exactly, either bullish or neutral. Well, I've only taught you one neutral trade. What was the neutral trade? The only neutral trade I taught you was the covered call. Okay, so it's either bullish or it's neutral. Well, do we want to go bullish immediately? No, that would be way too risky for an option. Now, if you were buying the underlying ETF, maybe. In fact, let's make that jump right now. Okay, this is the index. This is the NASDAQ index. Okay, we cannot trade the index directly. What do we trade instead? We trade the ETF, the Exchange Traded Fund, QQQ. Okay, now, this is essentially... it's going to trade just like the NASDAQ. If you're going to trade the Qs or if you're going to trade spiders, you always want to look at the index first and then come over to the Qs or the spiders, okay, and take a look at it. And the way that the Qs are shaping up here, to update the chart, we should put a resistance up here so that matches up with what we've got on our NASDAQ index chart, okay? So now that you see this, let's say that we're thinking, well, no say about it. Let me just write it out here. We are either going to be we're either going to be bullish or neutral. Bullish or neutral. Bullish, we have which strategies to choose from. We could buy calls or we can buy stock. Neutral, what do we have to choose from? The only neutral strategy that you have is a covered call, which is going to require buy stock and sell a call. Okay? Now, there's no reason that we can't do it. I'm just telling you that's the only neutral trade that we've got at the moment. Okay, so which one do you guys want to do? I'm going to let you guys tell me which one of these do you want to do? You want to buy some calls. You want to go do bullish trade. Some of you, a couple of you want to do the covered call. Most of you are saying you want to buy calls. And some of you are saying wait. All right, let me ask you a question. Do we need to wait? Do we really need to wait? Is there anything that we could do today? I have to trade this today. What's my trade setup today? My trade setup today, nope, not going to do a straddle, nope. My trade setup today is I'm going to set it up. If it breaks bullish, it's going to go bullish, right? We're in a bullish trend. And if it goes sideways, then I can do something with a covered call, but it might be a little bit risky because I have the underlying. What if we did this? What if we simply said, if I go bullish here, and I'll put a trigger in here, if I go above $71, then I'll buy the $70 Qs. Does that sound favorable? Would you guys say, if it goes above $71, then I'll buy the stock? Okay, so let's do that. So let me come over here, and I'm going to pull up some option house for us, and we're going to go place this trade. Okay. Now that we've gotten over here into this account, I'm going to do the new one here because we always think that one looks cooler. All right, so we said we're going to deal with the QQQ. Are you pulling me up here? What's going on? QQQ. I clicked it. And obviously, it's not thinking like I'm thinking. Oh, there it is. Okay. I guess it did pull it up. All right, so we say if it goes above $71, then we're willing to get into our Qs trade. The question that we have is, which month do we need? Based on what we learned before, being the last class, what should our criteria be for buying a call option? Anybody remember? What's the criteria for buying a call option? We want to buy 1 or 2 strike prices in the money. ITM, in the money. NTM, in the money, okay? So first bullet point, 1 or 2 strike prices in the money. Well, I said that if we're going to buy at $71, if the Qs are above $71, then we'll buy some options, okay? So we could go 1 strike price in the money and we'd be at the $70 Qs. Okay, so that would be 1 strike price. If you want to go 2, you'd be at the $69. So either one, the 69 or the 70, okay? Now, what's the next principle that we said we want to look for? You want to buy at least 4 weeks of time. At least 4 weeks of time. Okay, so if expiration for October is in 25 days, is that 4 weeks? It's right on the cusp. It's right on the cusp. If you know you're going to be in this trade immediately, I would let you get by that if you're going to be in it for like a week. Okay? We don't know when this trade's going to trigger, do we? It might trigger tomorrow. It might trigger in 3 weeks. We don't know when this trade's going to trigger. So let's do November. Let's go to November. We got a couple of months to expiration. We'll come down here, $70 call option. Is this going to meet the next criteria, which is a good delta? And I said, ideally 7 or more. Never, it looks like a multiple. Never less than 5. I'm just looking horrible here. Never less than 5. That's what I'm trying to say there. Okay, so let's pull up the delta here. Well, to do that, I got to add the deltas in here. So I'm going to come in here to my custom chain that I like a little bit better. No, I didn't put the deltas on there. We'll have to go to my pro chain here. I thought I put my delta on there. Here you go. All right, now we can see all the deltas. And just so that you guys can see this a little bit better, let me see if I can zoom in. There we go. Can you guys read any of these? Well, let me really zoom in. Okay, we're going to go down to November. And there we go. There we go. Look at that. Look at that. I think you can all see it now. All right. Okay, so we're looking at the 70 November calls. It's going to cost $1.47 per share to buy the calls. Let's go look at our delta. Uh-oh, our delta is 49. Well, shoot, can we do this trade? What do you guys think? Can we do the trade? Maybe. Thank you. Thank you, the person that said maybe. Who said maybe? I lost your name in here, but you're in the sea of no's. Okay, here, why would I say maybe? Because we haven't triggered the trade yet. What's the current price of the stock? The current price of the stock is $69.73. We are not going to get into the trade until the stock has increased to 71. So we've got an entire dollar and a few pennies before we cross over our trigger. At that time, what will this option premium be worth? How do we know what the option premium is going to be worth at the time if we've set a trigger? Based on your delta. So 50 cents, okay, 50 cent will be the increase in the stocks or the option. So the option, if the stock goes up from 69.72 to 71, we'll have a 49 cent increase plus a couple more pennies. So this premium is actually going to be more like $2, maybe $2 and a couple pennies or something. And what's the delta going to be? Anybody remember which number deals with the delta? Which Greek deals with the delta? No, it's not rho. Is it the vega? No, vega has to do with volatility. Theta has to do with time. It's the gamma, isn't it? And I don't even have gamma on here. Shoot. I thought I did the hold on a second. No, let's see. There we go. Okay, now let's get all my Greeks on here. And now my numbers just changed. Where's my November? There it is. I got it. Well, my drawings are a little bit off. Forgive my circles here. Okay, so back to my 70 here. The gamma is 10.2. If your delta is 49, with a $1 increase in the stock, this delta is going to increase by 10.2. So it'll be 59. Just wrote that wrong. 59.2. Oh, now we're over the 50 mark. And what would happen if we went one more strike price? The 59 would go up by 9.4. So that's going to be almost 70. Okay, so I'm actually okay. Even though 59 is not an ideal delta, it's not going to sting you. Okay, and actually you'll end up with a little bit better ROI. It's just a little bit less stable. 69 or 70 delta will be, 69 or 70 strike price will be fine for this trade. Which one do you guys want to do? I'll let you guys decide. Which one do you want to do? Open interest is perfectly fine. We got 58,000 and 24,000. We're fine on open interest. Yeah. Okay, so some of you are saying 69, some of you are saying 70. I'll go with 69 because I want to go with the majority of you. Okay, so what I'm going to do is I'm going to click on, oh, by the way, now we're not dealing with the 147 bid or ask price. Instead, we're dealing with 207. If the stock goes up one more dollar, how much is that going to be? It's going to be an extra 59 cents. Okay, so it'll be an extra 60 cents basically. So it'll be somewhere in the 270 range, we'll say. Give it a few extra pennies there. Okay, so that'll be about the price of this option when we do it. Okay, so we're going to click on the 207. I'm sorry, guys, I can't be zoomed in this far and see everything when I start clicking these prices. So I'm going to click on November $69 call option, and I'm going to click on buy QQQ. Boom. Now that brings up our ticket. I'm going to zoom back in here so we can see all these details. Is this interesting to you guys? I mean, you guys liking this detail, or is this boring the crap out of you? If I'm boring you, just tell me, and if enough of you are bored, I'll stop. Most of you are loving it. Okay, great. Always one person doesn't like it, but, you know, the rest of you are loving it. Definitely cool. Digging it. Give us the details. All right, great. Don't you love the voices that I assigned to you? Okay, so we have assigned in here the QQQ. Oh, come on, computer. Stop that. There we go. QQQ. We're going to buy to open call options, November $69 calls. How many do you guys want to buy? You want to buy one? Come on, let's get our money's worth here. Let's buy 10. Okay, let's put some money on the line. Now, do you want a market or a limit? Well, if we do a limit, what's the problem with doing a limit? We don't know what the price is going to be. We can estimate, but we cannot say. So if you did a limit, you have to do a little bit more math, and you have to say when this triggers my trade at $71, when the stock is at 71 and it triggers this option is going to be worth, we said, at least 60 more cents, probably a little bit more. So if we did a limit, we would have to come in here and estimate, and we would say, well, I'm only willing to pay $280, for example. You know, if it's more than that, then don't buy it. That's a little too much work for me. In the heat of the moment, I say just do a market order. Okay, that's a little bit easier. Just do the market order. With a trade like the QQQ, you're not going to get huge spreads. I mean, we got 3 pennies here. You know, you're dealing with something that's less traded. You know, something that has 100 open interest. You'll end up with a 50-cent spread. That's when limits are a big deal. With something as heavily traded as the Qs, it's not a big deal, and I'm not gonna worry about it. That's what I'm trying to say. You're not gonna have massive slippage. Slippage is when you place an order and it gets filled at a much different price and it costs you a lot of money. We're not gonna have that major problem here with an order like the QQQ. Okay, so we're gonna do a market order. Now, are we ready to go? Yes or no? Are we ready to go? Place the order? No, we got to set our trigger. So I'm gonna come over here to the trigger, and I'm going to turn it on. And now you see I've got 2 orders. I got my trigger order. Why does that keep happening when I turn my drawing tool on? I got my trigger order, and I've got my main order, okay? Now, what was our criteria? We said if the last price is less than, no, we want greater than $71. If the last price is greater than $71, good till cancel, then buy my Qs. Well, here's the problem. It's not going to let you do a day order and a good till cancel. So we got to change this one to good till cancel as well. Okay, so now let's read this whole script. If the QQQ stock has a last price that's greater than $71, good till cancel, then buy 10 contracts of the QQQ November 2012 $69 call at a market price. Estimated order $2,070. We know it's going to be a little bit more because the option will be more at that time. What do you think? Ready to do it? Let's do it. Place preview. You can preview the order. Here's your order summary up here. What I just read to you. Here's your message. You are able to place this. Of course, the market's closed, blah, blah, blah. Here's your estimated cost, $2,070, $10 commission, blah, blah, blah. Of course, that's going to be off because we don't, you know, it's going to be more expensive at the time of the order since it's a contingency order. We place it, we're done. Now, we close that, and if I come down here, sorry, I got to zoom out so I can see. I'm so close. This is a good lesson in life. Sometimes you just get too close and you can't see. Come on, computer. You can zoom out. I think you can zoom out. Whoa, what do we do now? Oh, my. What have I done? Oh, boy. Do I have any? Oh, I know what I did. There we go. Oh, that is a mess. Forgive me. Forgive me. I am just a disaster at this moment. All right. What I'm trying to do here, I want to click on my account tab. There we go. Now, if you come down here to my orders, this is what I want to see. I have two different ways to zoom, and I zoomed one wrong way. All right. Paul is going to laugh his butt off when he hears this recording. Here you go. The QQQ November 12, 69 call. You see the T? That means it's a trigger. It's not been triggered yet. It's just sitting down here waiting to go. We could cancel it if we wanted to. Status is open. We just placed an order. Okay? What do you guys think? Alexis is still unclear. How many of the rest of you did I confuse? We just did a whole order setup. Did I help anybody or did I just confuse everybody? Michael says it's not funny. Michael, what's not funny? I'm sorry that it's not funny. I don't know what to do, Michael. Okay, Kurt said he didn't hear a joke. There really wasn't a joke. It wasn't supposed to be funny. All right. We got 10 minutes. What do you guys want to do? Yeah, you just have to practice it. Yeah, you guys just have to practice it, honestly. Alexis, I would love to help you out, dear, if you can clarify where you're confused. Let's do another example. What kind of an example do you... Mariana wants to do a covered call. Let's see how far we can get in a covered call. Let's do a covered call for the same trade. Okay, let's see how far we can get here. Sometimes because the market's closed, sometimes it's not as easy. It's a lot easier sometimes when you just place the order and it gets filled because the market's open. But let's see how far we can get here. Okay, so here's the idea behind the covered call. What I want to do with this order is, let's say that we believe that the Qs are actually going to go down for the short term and up for the long term. This is where the covered call would be beneficial right now. We want to buy the Qs, and that's going to be the stock, and we're going to then sell a covered call. Okay? Now, here's the beautiful thing about the covered call. When you sell the covered call, that's money that's coming in, and that's yours. Okay, so the only real risk you have is buying the Qs. That's really your only real risk. Now, if you sold a naked call, you're taking on all sorts of risks that I don't even teach you about because I don't want you doing it, at least not right now. Now, one day, if you want to get to the point where you can do naked calls, then we can talk about it. But that's a very advanced strategy. It's a very risky strategy, and I really don't want you doing naked calls. But covered calls are great. They're the exact opposite of risky. Okay, so in order to buy the QQQ, what must our assumption be about that leg of the trade first? Because when we get into multiple legs of trades, it gets a little bit confusing. Okay, so the first thing you have to do when you're dealing with multiple legs of trade is think through each leg. Well, leg number one is going to be buying the QQQ. What would the criteria be to buy this? Well, this is going to be a bullish or bearish trade. It's going to be bullish. Okay, now would we want to buy the QQQ if we were in a bearish trend? No. But what if you're in a bullish trend that has stalled? Is there any danger in that? A bullish trend that has stalled would have a higher probability of continuing one day, right? It would have a highest probability of continuing at some point. Okay, so we can buy the QQQ knowing that we're in a stalling bullish trend that does have a high probability of continuing. Okay, so we're going to do that here in just a second. Now, the second thing you got to do is sell the call. Now, we would sell the call if we're bearish or neutral, because when you sell a call, are we long or short this position? We're going to be short the call. We want the call that we sold to go down in price. Okay, so understanding that as your basis, let's go over here and let's immediately buy some QQQ. And I'm going to be completely honest with you. I have not done this trade setup after market hours in Options House. So I'm not sure how many of the legs it will let me do, but I think I can do all of it because of the conditional orders. So here's how we're going to do it. We're going to do a one triggers order. That's the order that we're going to do. One triggers order. And I'm going to set a trigger to trigger the order. And I'm going to do that by clicking on the trigger button here in just a second. So here's what happens. Zoom in so you guys can see. Okay, ticker symbol, QQQ. We're going to do the power shares QQQ. Okay, it's going to query, it's going to pull in the information that we need. We're going to add a stock leg. Okay, so we're going to do a stock leg, and we're going to do a market order upon open tomorrow. Okay, we're not going to ask any questions about the price. We're just going to do it. Now, this leg right here gets us into a long stock position. I said we're going to do a trigger. I didn't mean we're going to do a trigger. This is all we need to do right here. We just need to get into the trade. Okay, now, the next thing we're going to do is we're going to trigger, once that order is done, an option leg to buy or to sell. We want to sell the covered call. Okay, so let's go out here. Let's sell the October, and let's sell above our current strike price. So we're going to be buying in the 69 range. Let's go up here and let's sell the 71. Okay, let's sell it for a market. Well, it turns out the income's only 40 cents, and you say, well, I don't like that. I want more. So you decide you can go out here to November. And now you're starting to bring in a little bit more. You do a market order. Turns out that the $71 strike price that I'm going to get back to here is $95. Okay, so you decide that you're going to do a market order for this. Now here is your order. Take a look here. Leg number 1, leg A, is order 1. That is the order to buy the stock. You see, it's the stock here. Buy the stock. 100 shares. That's enough to do a covered call. Market order. Okay, now order 2 is, as soon as that order is filled, turn around and sell the November 12 $71 call, 1 contract. Now, could we do 10 contracts? We can't do 10 because we don't have 1,000 shares. So we're just going to do 1 contract at the market order. And then you can see your spent is going to be $69.77. You're going to receive about $95 plus your commissions and minus your commissions. Now, here's your order summary. I'm going to do this in the preview so you can see the whole thing. Here's your order summary. Buy 100 shares of QQQ stock at the market price. If that order executes in full, it should say when, but legally they're going to say if. Then send the following order. Sell 1 QQQ November $71 call at a market price, okay? Now, this is the whole covered call set up, and we can hit place order. Now, if you place the order, that trade is gone. Okay? Boom, we just placed the order. The trade has been sent tomorrow morning, because I did all market orders. Tomorrow morning, doesn't really matter what I think. Tomorrow morning, that order is going to be filled whether I like it or not. Okay? What do you think? Okay. Now, there's another way that we might be able to do this in Options House. This is what I haven't played with. I'll just check it. We'll just do a basic order. We'll do the QQQ. We might be able to do it all in one ticket without even having the 2. And the way we would do it is we would add a stock leg and we would buy. Yeah, we can do this. I think we can do it all in one ticket here. Let me show you this. If you did it all in one ticket, the one I just did was a 1 triggers order. Order triggers order. So when one order is filled, the next one. This one would actually be somewhat of a simultaneous, and I think it will let us do it. Some brokers let you do it on one ticket, some do not. So what we could do here, let's go down to our $71 call, and we'll do markets for all of it. Okay, so here would be your order summary here, and this just puts it all in the same ticket. You're buying the stock at a market price, and then you're selling the option at the market price. That becomes the covered call as well, okay? And I think that'll let us do it. We'll see right here. Yeah, it says you can do this trade. So they let us set it up that way on Options House. I never set it up that way, but you totally can, okay? And it might be a little cheaper with commissions that way. I didn't do all the math, but it might be. Okay. Yeah, Rick says, if I already own the stock, do I merely sell the call? You do, Rick. And Rick, who's your broker? With Options Express, you just go in and in your positions tab where it says trade, you can hit trade. And then when you fill that order form out, if you set that trade up as a sell, a call against it, it links the 2 orders together. Not all brokers do that. You're in TD. I don't know how TD works. You might just call TD and work through it with them and see how it works for them. Okay? Because every broker is just a little bit different. Yeah, okay. Tom says, so if QQQ keeps going up, you keep the $95. That's correct. Okay, so let's zoom out of here. Let's come back over to our chart and let's see what would happen here. Okay, so we just purchased, I didn't look at the quote we got, but it's about $69.74. So we just bought the stock at $69.74 for $6,974. Okay, and as Tom said, we brought in $95 or about 95 cents from selling the call option. Well, we sold that call option. I got to put more space up here so we can see it. We sold that call option for expiration in November. It's way out here. Okay, not my favorite place to sell a call, but I wanted to show some money for you. All right, so we sold the call here. Okay, so if the Qs, and we brought in $95. Okay, so if the Qs stay flat or do something like this between now and November, all $95 is yours to keep no matter what, Tom. Okay, that's if the Qs stay flat. If the Qs go down, Tom, you still get to keep the $95, buddy. The $95 is still yours to keep. Granted, you are losing money in the equity of the stock itself. Okay, so that's where you start to lose money, is you can lose equity in the stock. So that's the danger of the call option, of the covered call. Okay, now what happens if the Qs go bullish? Well, you're gaining on the equity of the stock, but only up to the call option. Why? Because you have just entered into an obligation to sell because you sold somebody else the right to buy. So, Tom, what happens at that point? Well, at that point, you're forced to, and I'm going to write this over here, sell QQQ at $71. Okay, well, that's not a loss. You invested $69.74. So, you did $71 minus $69.74 is $1.26. That's going to be pure profit. Plus, you made another 95 cents on the option premium. So your actual profit on this trade right now, you can go do this trade tomorrow. And if the Qs go up, you will make 126 plus 95. Oops, 126 plus 95 cents, $2.21 times 100 shares if you did it for one contract. So 221 times 100 is going to be $221 in profit. Now that would be on an investment of $6,974. And that's not including your commissions, but it's about a 3% ROI, and that would be in approximately, a month and a half. So Tom, that would be a scenario. That's if the Qs go higher. So if the Qs go higher and on November, the third Friday in November at expiration, the Qs close above $71, Tom, you're going to sell your Qs for $71. You'll keep all of the option premium, the $95 from the option premium. You'll have a 3% profit in about a month and a half. Okay? Now, if the Qs stay flat, you'll keep your 95 cents, plus you'll keep the Qs. If the Qs go down, you'll keep the 95 cents, plus you'll have your Qs, but they will not be worth as much. So you will actually have a loss of equity, but you won't necessarily have a direct loss if you don't close the trade out. So the maximum from selling the call is not the maximum income from the call is $95, Puri, but it's not the maximum profit. The maximum profit would be selling the call and selling the stock. Yes. Okay, great question. What if you sell this $71 call? Okay, so you sell the call, the Qs go up, and you think to yourself, I don't want to get called out of this stock. How could you get rid of your call? Do the opposite. What did you do to open it? You did a sell to open. So that's a short. Okay. To get rid of that call option, you buy it back. Buy to close. At that point, you're going to spend more money, but you'll buy to close, and you no longer have any obligation, and you can continue owning your cues indefinitely. All right? What do you guys think? Is this valuable? Did I help anybody, or did I confuse you? Puri, we are not talking about bull call or bear call spreads at this moment. We're not talking about spreads at all. We're just talking about a covered call and the basic stuff. All right. Any other questions before we call it an evening here? A lot of you say that this was very valuable for you, and that is good because I'm wanting to know that feedback. All right. Here's your action steps. Review the classes you feel you need to review. As you go back through the last several classes, think about the classes that you need to review. And as you think through those classes, recognize, oh, I need to learn more about this, or I need to clarify this. Okay, so just start making some notes of the classes that you need to review. Set up several option trades in your virtual accounts. I was hoping to do more than what we did tonight, but we did one really in depth. So the only one we did tonight was the cues. You guys can go set that one up in your virtual account. I would suggest that you go through the top 10 or even more. Set up a whole bunch of them. It doesn't hurt you to set them up in a virtual account. Now, don't be foolish. Don't just go set up 10 trades in your real account. Just go set them up in your virtual account where you can learn from the pluses and the minuses of it, right? And then in that process, working, pulling everything together. Go through all 5 steps of the trade confirmations, start pulling everything together. And at this point, we're getting to the point where, since we're pulling it all together, you really need to rely on your other students. This is really going to be a big help. For example, Paula, you're saying, hey, I think I need some coaching here. I'm confused. You might be surprised. Some of you that are confused tonight, you get on the social network and you get in the group here for this class and you start talking to the other students. Guess what? A lot of those other students can give you the answers that you're looking for, and you're not as far as you think. A lot of you are literally an inch or two from success, and you're feeling like you're a mile away, and you're really not. You're just a little bit away. And so the fastest, quickest way is get on the social network there at tradesmartu.com, get on the groups, and just start talking it up with your other classmates and see what kind of great feedback they can give you. And then, of course, if you need a one-on-one coaching session, call your student success coach, go online, schedule a phone call, send some emails, and they are really good about getting back with you and engaging with you guys, because we don't want you guys to be totally lost or totally confused. Okay. What other questions, comments could I give you guys tonight? How often do I use a covered call? Pretty much never, Darren, because I don't usually buy stock. If I did a covered call, I don't even want to tell you what I'm going to tell you. It's going to slip out, and then I'm going to have a billion questions, so I shouldn't say it, Darren. But I'm going to say it. If I did a covered call, Darren, I would do it in the form of a debit spread. A debit spread is a covered call where you own no stock. And now the question is going to come flying in. What's a debit spread? What's a debit spread? And I'm going to have to end on that note because I'm not going to get into teaching all that tonight. John says, anybody home? Does anyone use Options House? John, a lot of people use an Options House. To connect to those people, I would suggest you get on the social network and see who's using Options House. Okay? Yeah. Wednesday night, when we get together, I'm going to talk to you about setting up your own trading plans based on everything we've talked about so far. So it's going to be a great class. Looking forward to it. And I will see you bright and early at 7 p.m. Central Time, 8 o'clock Eastern Time for Foundations of Stocks and Options, Level 3, Class 6. You guys have an awesome night. Good night.